You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 3 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuikStrike, options pricing and analysis software. QuikStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuikStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuikStrike is the perfect addition to your trading toolkit. Learn more about QuikStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuikStrike1. That's QuikStrike1. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky tune means it's time for TWIFO. This Week in Futures Options, a program here on the old Options Insider Radio Network, where we break down all of the fascinating and sometimes head-scratching activity that is lighting up the world of futures options. So your crudes, your gold, your soybeans, or whatever is lighting it up, fluid milk, whatever is hitting it up and lighting it up that week. On the futures options side, we will break it down. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network, where you too can dive into the great archives of this fine TWIFO program. If you want to say to yourself, hey, what were they talking about maybe back in Brexit time, or perhaps around the election, or some of the other crazy turbulent periods of last year, well, you can check it out. Head on over to theoptionsinsider.com or subscribe to TWIFO, or indeed to our full network over there in iTunes or TuneIn or Stitcher or wherever you like to get your favorite podcast. You can check it all out for yourself. And of course, if you're available, we love to see you live. We changed it up a little bit newer time, a little bit earlier time here for the live stream of TWIFO. So if you're around, you're available, you'd like to join us 1:30 p.m. Central via Mixlr, MIXLR. You guys know the link where you can get it there and listen to see how the show is made, see it live. So for all you guys who are always writing in saying, I don't want to wait for the beautiful edited product to come out, I want to get it live immediately. There you go. We got it there for you. And of course, that'll stay up there on the Mixlr afterwards. So if you want to check it out again later this afternoon or before the edited version comes out on the network, you can check it out there on Mixlr as well. And of course, however you listen, hit us up with your questions, your comments. We love to hear from you guys. And joining me on the old program today, my usual cohort, my compatriot, my partner in crime, Mr. Nick Howard, the founder of Bantix Technologies and the creator of a little platform we like to use around here quite a bit called QuikStrike. Nick, welcome back to This Week in Futures Options, sir.
Hey man, good to be back. We get started with the new year instead of the recap from last week. I think we got some interesting stuff to talk about, following up on some things we covered at the end of last year. So looking forward to it.
Yeah, and also, like I mentioned at the top of the show, and like our VO man said there at the top of the show, we also are joined this program every week by our friends over there at CME. They can't always be on the show, but they sponsor a cheer here, so we can bring on lots of great guests from throughout the world of options and derivatives. And to kick off those guests here on TWIFO, filling in on the CME chair, we have Mr. John Nelson, the founder of the Applied Research Company and creator of another little product we like to use around here quite a bit called OptionWorks. John, welcome to This Week in Futures Options.
Thank you very much. Happy to be here.
And John, since this is your first time on TWIFO, why don't you go ahead and give our listeners a little bit of an overview of what it is that you do and what the heck OptionWorks and the Applied Research Company are.
Okay. Applied Research is a CTA. We've been a CTA for many years. We currently just concentrate now on research and consulting projects. One of our research products is called OptionWorks, which is an end-of-day database of implied volatility numbers and models, and some technical stuff, very similar to, it complements some of the stuff that you see in QuikStrike. It's only an end-of-day product, though, so it's not a real-time trading product per se. It's more of a research product. And then we also offer some research reports with some trading recommendations built off of that come out every day.
There you go, listeners. So you can check it out for yourself. Speaking of checking things out, by the way, if you like to follow along, I know a lot of people like to do it live. You can head on over to cmegroup.com/TWIO, not TWIFO, TWIO. This Week in Options, and you could just literally put in any symbol like Nick and I are going to do right now, and you can get a nice week of reports. You can see what the hot things were this week. And Nick, we're actually going to mix it up a little bit this week. You know, we talk a lot about crude, and we're going to get to the specifics of what we're seeing out there in crude activity right now. But the crazy trade of this week, it's got to be out there. It's crude related, obviously, but not just WTI. It is indeed the big crazy activity we've been seeing out there in the WTI Brent spread. You know, listeners, you've listened to the program for the last few weeks. We were talking about how that was starting to heat up out there. We're starting to see a little bit of activity. Of course, at WTI, mostly West Texas Intermediate. Obviously, that's more of the domestic product. Brent, the more international. So you have more logistical separation between those, shipping and other things like that kind of lead to that spread developing. You also have international tariffs and things that get involved. And some of that latter portion seemed like it was going to be in flux. Hence, a lot of activity in the WTI Brent spread. And we thought maybe that was going to be a little bit of a flurry, and then it would die off. And boy, were we wrong, Nick. It's back with a vengeance this week. Of course, a lot of that coming from the tax side, a lot of potential taxes on Brent overseas. And whenever we see changes in taxes, it's going to change up that spread. I know, Nick, you've been watching this spread quite a bit over the past week. What's catching your eye out there in this? We don't usually lead off with our crazy trade of the week, but this one was just so crazy. What was lighting it up? What was catching your eye out there in WTI Brent spread activity this week?
Yeah, well, thanks, Mark. I think first off, let's take a step back and sort of recap where we started covering this. So if we go back to the second or third Friday in December, 12/16 it was, you know, we first saw this kind of stuff happen, and we started really tracking that trade at this point. So if you go into TWIO and you actually go into the settings button on that report and you go back to previous month, you can start to really take a look and see how that activity really kicked in December. But you'll recall, you know, the thing that caught us by surprise was the fact that people went out all the way into June and December of 2018 to start making these trades. And they were trading initially the parity calls or the zero strike calls, basically saying that WTI and Brent, there was no difference between the price. Okay, so I guess since I've been paying attention to it, the more obvious thing that came about was they went further out there because the curve is a little bit tighter back there than it is in the front portion of the term structure. So that I was able to at least figure that out over the course of the last few weeks. But you know, like you said, we got some trade out there early. There was 13,000 that traded, and then, you know, it kind of bumped up. But what we saw is this keep trading and trading higher and higher premiums, and the spread wasn't tightening all that quickly. You know, it started out around two, the difference of, WTI was two less than the Brent, or a little bit more. And I believe the at-the-money strike back when we were talking was a negative 2.5 strike. Well, we've moved all the way up to almost a zero strike, a negative quarter at this point. And we've seen that trade not only move in the parity in the June and primarily in the DEES contract out in 2018, but it's moved all the way in. We're seeing open interest in March contract of 2017, the June contract, the August contract, the December of 2017 as well. So this trade is, when we started, that strike was basically the open interest for that product. Now, it's still a great deal. Open interest is primarily in the calls out in the December contract, but we did a little research, and the high open interest prior to what was going on was back in 2013, early 2014, where we got to about 123,000. We're now almost at 140,000. So I would think we can say, and this is just based on knowing that previous fact, is that we're probably at the highest OI that this product has recorded. So some really interesting stuff. And the thing is, this started trading at like 20.2 in terms of premium, or 20 cents, however you want to look at it, but it's 0.2 times 1,000, so about $200, and it traded all the way up to 70 back, when it was trading early on in that initial flurry of trade. But that strike now is trading at about $1.60. So when you look at 0.2 to $1.60, you're looking at, an 8 times return. So somebody spent a lot of money way back then, because if you looked at the numbers that went up, I think back then we said 10,000 traded, even on 12/16 at a price of 65, 0.65, 65 ticks, or $650. So that $650 is now worth $1,600 on those same trades. So, you kind of ask yourself a question: what were people thinking? How did they know? Was it the people? Were there more trades that came and followed, or was it the same person sort of trading this up? I think what probably happened is people were moving in on the curve a little bit on the term structure and trading those strikes, but maybe the same group or party or parties were trading out further in the term structure and those same zero strikes. But the thing to keep in mind and to pay attention to here is, now we've moved outside of that zero strike, and we moved into the +1 strike, as well as 1.5 strike, all the way out to the +2 strike. So I think this week alone we have 13,000 that have traded in the +2 strike. So this is going to be a fun one to watch, because the term structure is basically crossed way out there in the December 2018, so it's almost flat. So we'll have to see how quickly that earlier part of the term structure comes into play, where we start to see the WTI eclipse the Brent from a price standpoint. But I think that we can call this. And I think it's interesting, right? Because this is a intercommodity spread trade. So the fact that options are trading on two very popular products, it just shows you the diversity of the trade that's available on the CME Group from a product standpoint, and the fact that it's increased, from basically zero open interest to 140 plus in a matter of a month, and with some really kind of interesting stuff going on. I think it's going to be a real fun one to watch.
Yeah, it has been kind of fascinating to watch. You're right, kind of growing from a very nascent product in its early iterations all the way to lighting it up. Sounds like there was a little bit, I wouldn't say informed paper, but well-timed paper out there in this particular product. And that's one of the reasons we like to do this show. We like to highlight some of this well-timed paper that we see out here in the futures option space. Because people aren't just buying, upside calls and apples and your Facebooks and whatnot. They also are out here doing it in your commodity and in your futures options, and in WTI Brent. Sounds like that certainly qualifies for my crazy trade of the week as well. John, I don't know how much you watch the spread activity. I know you watch a lot of the futures and the mothership options, but the spread stuff was kind of nascent, as Nick just said, till a little while ago. But this activity over the past week has been kind of crazy. Any of this really catching your eye over there in the Applied Research Labs, sir?
Well, what I did to prepare for the show today is I just took a look at the chart, and back to pretty much all of 2015, we were in the March contract, we were at about $1. The spread was at about $1. It fell down a little bit, came back up to $1, but since about the 1st of December, we've gone from $1 down in the March now. We're about 230. So just since the last 6 weeks, 8 weeks or so, we've lost more than $1 on the spread in the March, but in the Ds, which is the strikes and the options that Nick's talking about, over that same time, we gained $1. So the real trade would have been a calendar spread in
a nice time spread,
product spread, right? So that leads me to think that there's probably something going on fundamentally with maybe one of these two things, or I don't know, just the fact that the spread itself changed that much, that the term structure of the spread has been moving. There's a lot of moving parts to this. It's really interesting.
And Nick, I know you got this is just lighting up your tape over there. Some other stuff coming across your radar there. What else is lighting it up for you on the spread side? That spread, obviously that calendar. I'm gonna dig into that. Sounds pretty good. A buck on both legs. You can't really turn your nose up on that. What else you got, Nick?
Yeah, I mean, just from I would say for the people that are listening, I just would keep an eye on this. Not, as John mentioned, there's probably stuff going on internally in each of the contracts. Now, the WTI is what's trading on the CME, but this is a good way to track to see the relationship between the two products, and to follow up on what John was saying, the spread itself, right? It didn't move. The future spread itself between the WTI and Brent didn't move for a long time, and we're just really seeing this run up in this December part of the term structure recently. So if you go out there and look at this, BVZ8 is the symbol. Let me see, is that the correct future symbol? Let me look one more time here. It is actually, the bullet spread is, I think it's ABY on the Globex, ABY or XBY on the Globex, but that spread really was pretty tight. I'm going to go back and see here. It was pretty tight for a long time, and then it really just started to run up. So yeah, I mean, for me, it's more of I've been trying to find out and talk to, and nobody really knows what was driving some of this early trade. I think a couple shows ago we mentioned that it was probably a fund. We had heard from some FCM friends of ours that it was probably fund driven, but you want to know really what on the back end, and they've been so right on this. Remember when we talked about it initially, we did the math on the numbers just from that week in terms of I think we talked, it was like $22 million trade from a premium standpoint, and when you look at $22 million and we're talking about, as Peter Lynch used to say back in the How to Make Money in Stocks or whatever it was, an 8-bagger on this thing already. That's pretty amazing, or probably less than that when you average price the thing up. So, for me, I think you want to just keep an eye on this. You can look at the open interest profile tool to continue to take a look and see what strikes are changing. You could also continue to compare. If you're interested to take a look yourself, if you go back and look at the change since December 9th, you're going to see all the activity take place basically in the calls on the open interest for this spread option. 96 of the 98,000 in change in open interest has taken place since December 9th, and 25 of the 41,000 has taken place in the puts since then. So really a big kick up in this activity. And another thing I just wanted to mention is that, you're not going to see, if you want to take a look and see the activity on this, you can go to the and look at the block trades that are available on the CMEgroup.com website, and also soon to be available as a tool from QuikStrike on the CME website. So if you want to track what's trading, you could see this intraday, you could see these blocks trading, and look for a BV symbol, and you'll find it there. You can also see this in the CME Direct trading platform. If you bring up the WTI Brent as options, and then you attach a current activity tab in there as well, you'll be able to click on your option tab and see what block activity is taking place as well. So you got 2 or 3 different ways to track within QuikStrike itself, in the open interest profile tool, in the TWIO report on the CME Group website, on the TWIO report there, as well as the block trade page, as well as the block trade page that's soon to come, and then within CME Direct trading platform itself. So I think we're going to be talking, this is going to be like our soybeans of the first quarter, right? Soybeans last year, and
the gift that keeps on giving.
Show. we're going to probably going to be continuing to look at this until it dies down. And I mean, one thing I will say, the only other thing I will mention here, and I know John's got something to mention as well, is yesterday we saw, I think, and I'll call it profit taking. Yesterday is the first drop we saw in the parity strike, where we came off 3,000 in open interest. So it looks like, maybe somebody who bought those 20-cent ones probably finally sold it for $1.50 or $1.60, whatever it was, and then maybe could even sign off for the year probably if they wanted to, depending on who it was. So again, keep an eye on it, and we'll keep watching it for you, and we'll make sure that we mention it at least every week in passing if nothing happens in that given week.
I was just going to mention as some background information on this. If you just look at the products individually, and we track a 1-month implied volatility constant maturity contract. But traditionally, WTI has an implied volatility, or an oil VIX, if you want to call it that, maybe 2, 3, 4% higher than Brent. So the actual price itself, or the options associated with the futures price, tend to be a little pricier. That changed about a year ago, where it fell off, and then Brent was actually more expensive. And then steadily throughout the year, that spread, the spread in implied volatilities, that's come back to zero. And as of yesterday, it's almost exactly zero. So this is also something that's indicative of, again, maybe some other things that are happening in the individual markets. That's why what makes spreads so interesting is there's you have a third market based on two different things happening. Sometimes they're correlated, sometimes they're not. So it was just a little background info on some other things that are happening in these two markets.
Getting into the mothership WTI options themselves, another interesting week out there. Pretty decent volume week as well. Open interest up about 5.5%, or about 130,000 contracts out there. The overall futures coming off a little bit, kind of depending where you're looking on the structure, anywhere from like 1.5 to about 2 handles, actually giving vol a little bit of a boost. One of the first boosts we've seen out there in some time, up about a point pretty much across the board. That's kind of been a lingering discussion topic we've had on the show. We'll get into that again in a little bit, kind of what's going on out there in crude and WTI from a volatility perspective. It has broken through some floors that a lot of people, particularly new entrants to the space, thought had been well established there in 2016. And then lo and behold, surprising to the downside from a vol perspective. In terms of what was lighting it up, the hot strikes this week for WTI, number one with the bullet is the front month here, the 50 puts, just lighting it up for some size. The Feb 50 puts, 45,000 those bad boys are going up this week, including two big chunks of relatively similar size, about 13,000 and change going up on Tuesday and Wednesday. Those potentially closing, but about 26,000, 27,000 going up on those 2 days alone. The rest kind of scattershot throughout the rest of the week. So yeah, the 50 puts, maybe someone closing in there for a decent chunk, but still size activity going up out here in those Feb 50 puts. And then followed number two by, it is kind of always this close tug of war between near term puts. In this case now, the 50, it's like at risk reversal breaks out 50, 60, 50, 55. Some week, this week it's 50, 55. With the 55 calls doing far less, doing 27,000, nearly 20,000 contracts less this week, including a big chunk of about 8,000 there on Wednesday, a good chunk of that opening as well. And it followed on the heels by the Feb 51 puts. So a nice little put strip, 50-51, with about 26,000 lighting it up there as well. Pretty evenly broken down throughout the week. And as Nick alluded to earlier, he may want to get into this a little bit later too, there were some other funkier trades a little bit farther out. You go out to about June, I believe here. You got the 60 calls lighting it up pretty aggressively to the tune of about 15,000 this week, of course, including a big block of about 10,000 on Tuesday, nearly half of that closing. So it could be someone is perhaps deciding discretion is the better part of valor, and deciding maybe the 60 strike is a bridge too far this week, and closing it out this week. Either way, 15,000 of those bad boys lighting it up this week, with even some funkier, about 1,000 of the 65s in the May strike as well. So some people having some upside aspirations, but it could be potentially a lot of that is interesting and closing. And, Nick, on the volatility side, crude has, and WTI in particular, has been an interesting interesting one to watch. We've been talking. How long have we been talking on this show since we started it? Pretty much about how, from a volatility skew perspective, it was pretty much all puts all the time, and that was pretty much the case until about, of course, that big OPEC meeting when it really seemed to give some life to the near-term calls, and that life has kind of persisted throughout this last few weeks here. The risk reversal is staying pretty much similar from a net level here in a little bit. I'll let you dive into the QuikSkew individual segments in a minute there, but still, it's been interesting to watch that nearer term. So if you were saying to yourself, oh, this was really favorable for some bullish risk reversals, selling far out of the money puts, maybe in that 40 or even 35 strike range, and then turning around and buying some upside calls, maybe 55s, maybe 60s, somewhere around that range. That was favorable until the last few weeks, and now it's not so attractive anymore. The puts are still commanding a decent premium, but the calls have also gotten bid up, so you're not really getting what you used to get out there. Even though net vol at the money vol is low, again, it's a tale of skew to really see where you're going to be executing on these levels. So it's been an interesting thing to watch. I know, Nick, you really like to monitor the QuikSkew. By the way, you guys can play along, like I mentioned, cmegroup.com/Twio. You can generate your own report. You can see exactly what Nick and I and John are looking at right now here on the program. Nick, walk us through what's been going on out there in QuikSkew, as well as whatever else is catching your eye out here in WTI options this week.
Yeah, I think first off, I was really curious. Last week we didn't touch too much on the WTI, so we didn't really get it out there what we were thinking or what we thought. But I went back and looked again, just to mention, if you want to see what happened last week in the aggregate, you can go to the settings button and look at the week prior and to see the activity from an open interest volume and vol and all that kind of stuff. So I encourage people to do that, just because it's if you're out or if you forget over the weekend or you want to just kind of get fresh before the week starts, you can always go back and see what happened. So this week when I came in and I saw what was going on, vol, we had, vol was off last week a little bit, not much, but when I walked in this week, we saw there was like an early increase in the volatility, and I was a little bit surprised because we were really still trading within that range, right? We're still sort of in that 50 to 55 range. Remember, we talked about weeks ago how OPEC and we're trying to get through 55. There was a lot of 60 call buying back then. We never really got through 55. Vol got bid up, and then once that event was sort of off, things got offered again, right back to where they were. So when we started to trade, we traded a little lower, and I think people were hoping for a continued trade lower, and there was a pop in the volatility. I think, we started off around the 54.5 in the March contract coming into this week, and then we traded down to, 52.5 or so, maybe not quite that on Monday, but then we traded all the way down below almost 51.5 over on Tuesday. So we saw a vol increase to that point, and then once we sort of got back up again, when people realized there wasn't going to be any follow through, the vol came off again. So we did see a bid early in the week, and then we saw things kind of get offered to flat. So for me, I was surprised to see the bid, only because until we get through the 50 strike again, right, we have these natural barriers that we talk about just based on the just a still tremendous amount of open interest in this product and continued increases in this product, right? So we're at 2.8 million almost in open interest as of yesterday, with a 6% increase so far in the the first 3 years alone of the WTI, and that's pretty much where most of the trading is occurring. So I'm still I was a little bit surprised that we saw some volatility, given that we were still within that range, but it came off as we sort of moved back in there. So I think what we're going to see is the following. If we trade down, we're going to see hopeful people bidding things up just in case. And maybe that's why we saw a lot of the 50 puts trade early in the week, right? Because we saw that Tuesday, Wednesday break, and people thought, well, maybe this is our chance to get through there again, right? Because we're really looking to go through these open interest max OI barriers, and we just couldn't get through that. So I think if we continue the trend sideways, we're going to see vol come off again a little bit, and I think people are going to react to moves one direction or another, just based on the fact that I think a lot of it is hope based as opposed to fundamental based. But as far as the skew, not seeing much going on here in terms of a change. We see a little bit in the March contract where we're seeing a little bit of an appreciation to the calls, but that's really not carrying forward too far out on the term structure. But again, as we always mention, most of the activity is taking place in the first 2 contract months from a trade standpoint, with the exception of the June and December contracts that typically also see a lot of love from a trade and open interest standpoint. So, and that's where Mark mentioned a lot of our activity came from, in the 60 plus strike range out in the June 2018 and December 2018, to reiterate that, as high as 65, 70, and even 80 strike. And then as far as volatility, we had that little pop early in the week, but we're still down. If you look at the 30-day average, and John can probably elaborate on this, if we're looking at the 30-day vol, constant maturity vol, we're still on lows over. I'm just looking at a 1-year chart. We're still on the lows. We're not quite as low as we were at the end of the year, but until we start to see some new ranges here, it seems like some strangle trades are stuff to look at. So I'll let John go from there.
Well, John, yes, same question to you as well. Obviously, you guys over there in the Applied Research Company are running a lot of models and tracking a lot of products. I'd imagine a lot of people are hitting you guys up regarding WTI. It seems like it's the product that's just on everyone's lips these days. Any thoughts here on what's been lighting it up in the options, or in the net volatility, or in the skew, or indeed in the futures? I know you guys kind of track all of the above.
Now, as Nick mentioned, long about right before, I guess right around Thanksgiving was when we had a big buildup in vol, and it dropped off pretty sharply, and then we've been down in the 30s for pretty much since the 1st of December. But what's also interesting, as Nick mentioned, that the risk reversals have actually been creeping up, which means that the skew is tilting. The calls are getting a little pricier, and the puts are getting a little cheaper, even though the entire skew is falling, which seems to me that what might be happening is, since options have become cheaper, the call buyers are going further out. They're buying higher strikes because they can get upside potential really cheap now, as they're cheap, and they're moving even further out on the curve to buy those calls. And obviously with the market going up, puts are not as popular as they used to be. We track the correlation between implied vol and price for a lot of markets, and right now the correlation for crude oil is a negative 0.84, which is as high as I can remember seeing it. The correlation for the E-minis is 0.8. So, and we always think of VIX goes up, market goes down, vice versa, and that relationship is even stronger for crude oil right now than it is for the stock market. So that's remarkable.
Nick, I know you got a few more things on it. Then we'll have to dive into questions. A lot of people sending us questions here this week. Only had time to get to 2 products if you count the spread. But people lighting us up with questions too. But before we get to the questions, Nick, any final thoughts here on our old friend WTI?
Yeah, no, I think that's a great point that John made, and I think it's something that we probably need to look at more is to actually look at the price and the volatility and how those are related to each other. But the one thing I did want to mention, I wanted to make sure people got a chance. And Mark, I put the link in the show notes, so maybe we can tweet it out at some point. But if you're looking to see some more information and take a look at differences between, even day difference in volatility, open interest, constant maturity volatility, and you are a CME Direct user, there is, if you notice up in the top right corner, there's a market scans button. And what you can do is you can open that up, and it's going to elaborate on some of the integration that's now available within CME Direct going into the QuikStrike tools for you to do market scans. So you can, like I mentioned, you can look at constant maturity changes, open interest changes, all those kind of things. But if you could tweet out that link, Mark, it might give people a chance that are CME Direct users to see that new integration that has taken place. And those scans will hopefully be available on the regular CME Group tool page for QuikStrike in the near term. So a lot of the stuff that we're doing, we are looking at the This Week in Options report and making statements based on what we're seeing during that time on the show. Obviously, we're researching prior to that as well, but you can go out there and make those same same points to yourself by looking at the reports that we're reviewing. So I encourage you to go out there, cmegroup.com/TWIO for TWIO, and take a look, and also take a look at the scans through the CME Direct, because I think you're going to find some interesting things going on. Just as John mentioned, when you start to look at the correlations, there's probably a lot more there than we're even talking about on the show.
All right, speaking of a lot more there, let's get to a bunch of your questions here on our futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/theoptionsinsider, stocktwits.com/optionsinsider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, like the man said, this is the portion of the show where you guys get to fire off your questions. Got a lot here already. You guys have already hit us up with. If you got more you want to hit us up live, go ahead via the Mixlr, or a lot of you guys like to stream and then ask us in the social media. You can do that as well. Add options on StockTwits and Twitter. Probably the easiest place to get us quickly here before the show wraps up. All right, let's dive, see how many we can get to. Roger Barone asks, this is an interesting one. He says, why can't I find a broker that offers trading on ethanol options? And he used hashtag sad and hashtag mad. Poor Roger. He's sad and he's mad. I'm trying to think. I don't think we've hit on ethanol options during our TWIFO run here, Nick. It hasn't really made it to the top of our radars because it's competing with so many other products that have been doing so many crazy things, like most notably WTI and of course gold, and some periods there with soybeans and some others, flirtations with silver and others. So it's kind of interesting. So I don't think we've ever really touched on this, nor have we dive into the broker side of the equation. I know you've been looking into some ethanol related things of late. You got any advice for our friend here, Roger, who's both sad and mad, Nick, that he can't find a good broker for ethanol options?
I'm going to call him Roger Baroni, because there's a pizza place called Baroni's right across the street from my office. So I'm going to go with the Italian pronunciation. I'm surprised that Longo didn't go with the Baroni and went with Barone. Went with like the old Sicilian name versus the Baroni, which is the new Italian name. Anyway, so Roger, I don't know that I can say it on here, but if you want to message me, I did talk to a place that can help you out. I made sure that they had it available, and I'm sure I can point you in the right direction in terms of where you can find some ethanol option broker help. Also, keep in mind, if you go to the TWIO report and you go to energy biofuels, you'll see Chicago ethanol Platts, and then the straight up ethanol product. The ethanol product is a futures only, but the ethanol Platts, which is average price APO option, you'll be able to get a This Week in Options report for that as well. So yeah, no, don't be mad and don't be sad anymore. We can point you in the right direction and get you in contact with somebody who can help you out.
There you go, Nick. Nice guy. Not wanting to give plugs here on the show, even though, there are a bunch of firms out there you can choose from. But I'll allow Nick to not mention them specifically if he doesn't want to. Hit him up at QuikStrike1 over there if you want to, on Twitter, if you want to get the direct scoop. I don't know, John, any thoughts on that before we dive into some of our other questions?
No, I have to be honest. I don't track ethanol much. I don't have much to offer on that one.
Yeah, it's not a product we've really hit it up. That's why it was kind of fun. That's why I love the listener questions, because they take us in sometimes unplanned areas, which makes it always fun. This is a fun one. This is Cooper. He wants to know about copper. So I say that 5 times fast. Cooper on copper. Cooper, he wants to know, copper took off, but the move was short-lived. How do you trade that with options? I'm going to try pulling up copper here on the fly here, doing a little quick strike foo here while I'm trying to pull this up. I think this came in towards the end of last week, actually, so I'm not sure exactly what move he's referring to. Maybe last week. This week, copper kind of relatively quiet. For the most part, up a little bit towards the end of the part of the week, so up close to 5% during the week. So I guess a little bit of a ladder move out there. Of course, when you're talking copper options in general, just remember copper compared to some of the things we talk about, like WTI, or even to other metals like gold, it's a little bit different product, different use case. Obviously, a lot more industrial. And when we're talking, we just said in the big WTI options, it was 50,000 of those 50 puts went up. We're talking here for the week about 4,300 contracts total. So different beast entirely. Just prepare for that when you're going in here. We did see the leading activity out here. Looks like it was a March 2.7 strike calls. Copper in that $2.70 range out there right now, with about nearly 400 of those going up this week. So a little bit different beast. This kind of goes back to an old discussion we've been having on this, and maybe you have some thoughts on this, John, as well. Here, this ongoing and evolving use case between the futures and the options. I think people have always, they put the demarcation there where the futures are for some sort of intraday trade and the options may be a little bit longer term, could be a couple of days, a couple of weeks, a couple of months. Kind of interesting. So if you have any thoughts, John, on the copper move in general, I'll have to dig in to see if I can find exactly what move he was talking about, as well as maybe in general some thoughts on playing a quick gap with options versus the futures. Which way do you lean, and any other thoughts you may have on that?
Well, my basic thought is that copper is, excuse me, a lot like gold and silver in that the skew for those products is really interesting and fun to watch, because for so many products, the stock market, and we're seeing it in crude oil now, kind of the opposite is true in natural gas, is that the skew is always one-sided, because like the stocks are obviously a long-only market. People buy stocks and buy puts. But something like gold, and especially something like copper, because it's an industrial metal, people have exposure on both sides of this. So there are people who are worried when the price goes down, and people who are worried when the price goes up. And so the skew is symmetric. Very often it's symmetric. It's not tilted one way or the other, but then it also changes. So sometimes the risk reversal is positive, and sometimes it's negative. And so to look at the actual level of volatility, sometimes you can have a very flat volatility line over the span of a few weeks, but the skew has changed a lot. So the out of the money puts and calls are changing drastically in value. And even though you kind of don't see that from just looking at a volatility chart, that's what makes these markets really fun to trade, is because the shape of the skew changes, tilts back and forth, even if it kind of doesn't go up and down all the time. But as regards to a move, again, we'll assume he's talking about a move to the upside. If you look at a volatility chart, it's been pretty flat. So we haven't had necessarily, if you look at the money, that those aren't really necessarily rich or poor. But given some of this action that happens in the skew, what's really important then is which strike you pick, right? Because if you pick an at the money, then you're pretty much just making a trade on the direction of the underlying market. But if you're out of the money somehow, you're also making a skew trade, and you have to be aware of that when you kind of get into some of these products, some of these physical products that act differently than some of the ones we're used to.
Yeah, and am I on, Mark? Can you hear me okay?
Yeah, go ahead.
Okay. Yeah. So yeah, to elaborate on what John was saying, what we can do with QuikStrike is look at our QuikSkew number, and we could see how the calls and the puts sort of pivot against each other, with the at the money really not doing anything. So we'll what to John's point, he said it depends on what strike you pick, and that's absolutely true. I can take a look at like the 15 delta versus the 25 delta here, and you can see that the 15 delta has a lot more kind of whippy action in terms of being rich or cheap to each other, meaning the call kind of being more expensive than the put being more expensive in comparison to at the money than the 25 delta. So you have a lot of the wingy stuff that was really moving around quite a bit, and then the 25 delta is still sort of I wouldn't call it. I guess you could call it sort of a wingy, but it didn't have the same sort of motion in that part of the curve. So we'll try to tweet out some of those pictures so you could take a look for yourself, so you could see how that stuff has changed over time. But yeah, as far as the big move, the only big move I really see here is back in November when we had a little bit of a run up from like 225 up to 260, and then we did get a vol move, but then we sort of trickle back down on the volatility, and it's been nothing but sort of a slow grind down, even with a little bit of a retracement here on the future from a belly that we saw back in December. So we'll keep an eye on copper. Again, like Mark said, there's not a huge amount going on out there. If we look at this week in options report, the open interest is really only like 5,000 contracts across the first 6 or 7 expirations. Actually, most of that's taken place in the first 2 expirations. So it's fun to watch, and it probably some of that whippiness in the skew is coming from the fact that there's not a lot of open interest or not a lot of liquidity out there in those strikes. But that's what provides trading opportunity. So it's good to always keep an eye on this stuff, because maybe as this whippiness occurs, it'll draw more attention, which will have an increased open interest or increased interest in this product, which will obviously increase the open interest. And just as an FYI, this week alone, open interest was up almost 60%. So that's probably a pretty good indicator that there must have been some action out there, and a lot of that took place in the March contract. So that's all I really got for there, Brent.
All right, next up, we got a question from the real Justin. That's good, because I don't want the fake Justin hitting us up. Only the real Justins can hit us up. The real Justin says, he's got more of a comment. He says, I'm thinking gold's going to continue to run up to the inauguration. We didn't have a chance to chat on gold earlier, but it sounds like, Mr. Real Justin, you're spot on, at least for this week. Gold, the big COMEX gold futures up about 25 handles, back up to that 1,200 or so level out there. So about another aggressive run, about 2% rally. So at least for this week, your prediction is looking good. The options are also backing you up. Where the number one with a bullet strike was for this week out here was the Feb 1,200 calls. Surprise, surprise. Now the at the money, formerly out the money, now at the money calls, lighting it up to the tune of about 11,000 and change. A good chunk of that 5,000 coming on Wednesday, and a lion's share of that opening. So people are perhaps buying what you're selling there, Real Justin. They're thinking at least running into this week with the big inauguration. This Friday, our show next week is going to be pretty crazy, just because we'll be doing it on an inauguration day. Never done that before, so it should be kind of interesting. And then, of course, it wasn't all calls all the time. About 8,000 of the 10-half puts did trade as well, including a good chunk of about 7,000 on Tuesday, the lion's share of those closing. So maybe a little bit of a sad face for someone out there on those who was thinking this gold run was moving more to the downside south of the 1,100 strike. Surprise, surprise, Trump and the real Justin saying, nope, it's going north. And at least for the time being, the numbers seem to be backing you up. Nick, any thoughts here on what Mr. The Real Justin's thinking, as well as what the numbers are telling us out here in COMEX Gold for this week?
Well, I just want to reiterate what we've been talking about, over the last 4 to 8 weeks when it comes to gold. The vol was still really low, just from a overall historical standpoint. It's not on its extreme lows, but it's really still been very low. And because part of that is because we've been trending, and even though we had this run up of late, we're still sort of trending within a range of strike here. And I think right now we're probably safe to say it's between 11 and 1,200. But we did talk about a few weeks back about buying puts and buying futures, which would have worked well over this last few weeks, just because vol has stayed pretty steady, and we've obviously had a pretty good run up from a future standpoint. So again, it's all these markets have opportunities in them, and that's really the whole idea. We're kind of talking about what's interesting, or what's really kicking us in the shin, but it's worth running out there, taking a look, running through the different products, looking at the different activity and the open interest, checking out to see which ones are moving around the most, and see where that activity is in order to get some good ideas. But again, I'm going to say the same thing that I say with the other stuff. We're in a trending market in this, as far as I'm concerned. Volatility is going to stay low until we see something happen from a move outside of these price ranges. And right now, even though gold is up quite a bit, and it's basically up, been nothing but an upside since pretty much Christmas, it looks like. But until we really move out of a range. And right now, it looks like we're going to have to get up above the 1220 mark before people start paying attention, because there's probably an increase up to like 1280. So again, if you think that we're still too low, buy puts and buy futures, same as always. You get your money back mighty quick if we continue to run up, especially on a 20 or 25 delta option.
There you go. Paying that rent, sir, out there in gold. And didn't get a chance to even talk about rent. We'll get to that next week. John, take us home, sir. What are your thoughts here on our listeners' comment? He's loving himself some gold, as well as what you're seeing out there in the gold product this week.
This is a perfect example of what we talked about a few minutes ago. Right now, the risk reversal on 1 month gold or nearby gold is exactly zero. So we have a perfectly symmetric skew. Calls and the puts are equally more expensive than the at-the-monies. If we looked just back right before the beginning of December, just a few weeks ago, the skew was heavily toward the puts. Puts were far more expensive than calls were back then. And that shifted just in a few weeks now, even though the volatility curve, the at-the-money volatility curve, has been pretty uneventful. And lastly, the one thing I would point out here that is often the case with gold, except when we're seeing spike moves, is that the correlation between price movement and volatility movement is a negative 0.1. It's almost nothing. They're acting completely independent. A lot of that is because volatility is not moving much at all. But again, earlier we were talking about crude oil having a negative 8 correlation on vol and price, and gold is right now effectively not correlated at all, which is interesting at a different level, because we always used to have this relationship that between gold and crude oil that we could count on. So there's a lot of things happening. I don't know that I would point to the inauguration as maybe a source of any of this, but who knows? We'll see.
No, you're right. I've mentioned that a couple of times here on the program, that gold is one of my favorite examples of just the ever-evolving nature of a volatility skew. If you're coming to us and you're a typical equity or index options trader, you're kind of bored with the traditional investment skew you usually see out there in a SPY or an Apple, and it never really changes. It just evolves in terms of slope. The futures options got you covered because they're changing every week and sometimes every day. Gold has been all calls and it was all puts, as John mentioned. Now it's pretty much, at least in that front month portion there, symmetrical, which is interesting. So if you like the notion of some evolving skew and that intrigues you in terms of product developments, then I think they got you covered on gold and a lot of other futures options products this week. All right, that music means we've come to the end of another epic, and it was an epic sojourn through the world of futures options. We started off covering all things WTI Brent spread. I got a feeling we'll be talking about that one again sometime soon, as well as, of course, the activity out there in the big WTI options. Then you guys got involved and took us into all kinds of interesting places, including copper from Cooper and ethanol and even gold. So you guys, I love where you guys take us. If we didn't get to your question this week, I'm sorry. We get a lot. We only have a short amount of time to answer them. If you can, of course, always join us live. Love to see you in there. If you ask them live, sometimes we try to move those to the top of the queue. So if you're burning to get one in quickly or just get one answer on the show, that's a good way to do it, because sometimes we bump you up. But before we go, as always, I want to check back in with my cohorts here on the old TWIFO panel, see what's cooking with them. Let's start with you, John, our inaugural CME guest here on the program. What is cooking in the land of applied research and indeed OptionWorks? And if our listeners are interested in any of the stuff you guys have going, where should they go? What should they do?
Well, anybody can go to optionworks.com, get a 2-week free trial to our end-of-day option research that has some trading recommendations in it. We're looking for the projects for the new year is to kind of revamp some of the charts, some of the content. It's kind of in need of an update, and then we're going to expand into some new markets. So we've got a lot of work ahead, but pretty excited about some new things happening.
There you go. Check him out at OptionWorks over there, and you too can see all the stuff he's talking about, the evolving skew in various products and volatility and things like that. John and his team are always monitoring that stuff, so you can check in for them. And John, glad to have you on. I'm sure we'll have you on again on the program in the near future. And last but not least, Mr. Nick, what's cooking in the realm of all things Quick Strike?
Well, same thing as always. I say every week, if you want to get a taste of what's going on, go out to cmegroup.com/QuikStrike, QuikStrike. There's a bunch of free tools available out there. As we mentioned earlier in the show, if you are a CME Direct user, it probably behooves you to take a look at the integration. You can now put a QuikStrike link on every strike and trade that are in the different windows, so it'll open up supplemental information directly from the platform. And then I believe starting a week from next Monday, you'll be able to see QuikStrike embedded as its own window within CME Direct. So you'll be able to get at a lot of the stuff that we talk about is going to be available within CMED as an integration, as well as the tools that are out there on the CME website. So since it's a new quarter and a new year, you'll see some new tools be released in the very near term on the cmegroup.com website. So stay tuned, and we'll make sure we keep you up to date and tweet out that information as it becomes more available.
There you go, and join us next week for Inauguration Day. Should be interesting for as we break down all the hot activity in the world of futures options. Remember, new time, 1:30 p.m. Central, 2:30 p.m. Eastern. If you do want to join us live, of course, it's available after the fact on our network, and you can always get it immediately if you missed the live broadcast, but you want to get it a little bit after, before it comes out on the network. You can head on over to Mixlr and get the recording of the live broadcast there as well. And on behalf of John and Nick, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show, and of course for sending in so many varied questions. Keep them coming. We love hearing from you guys, and we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuikStrike, options pricing and analysis software. QuikStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuikStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuikStrike is the perfect addition to your trading toolkit. Learn more about QuikStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuikStrike1. That's QuikStrike1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.